the Property Pod. Welcome to the Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hello and welcome to the Property Pod, South Africa's premier property investor podcast. My name is Suren Naidu, and on this weekly podcast show, we gain insider insights from leading executives, analysts, developers and entrepreneurs in South Africa's expansive property industry. Will the residential property market surprise on the upside this year, with expectations for interest rates to start falling? Or will 2024, an election year in South Africa, see pedestrian growth for this sector? On this week's podcast, our milestone 90th episode, we speak to Siphamandla Mkhwanazi, property economist at FNB, about the prospects for the residential property market in SA this year. Siphamandla, the last time I spoke to you was when I hosted a SAFM Market Update show back in November 2022. Believe it or not, it's been a long time and the interest rates have spiked to post-COVID highs since then. It's your first time on the Property Pod, so welcome to the podcast.
Thank you so much, Suren, and how the world has changed since then. A wonderful 2024 to you and your listeners at large.
To you as well. We have a repo rate decision coming up from the SARB next week, Thursday that is, the 25th of January. What are your expectations? Is it too early for us to start to think about a decline or reduction in the interest rate cycle here in South Africa?
No, Suren, you mentioned a cut. I wonder why not another hike. I mean, for the last 2 years, the MPC has hiked interest rates in January. 2 consecutive years, we've gotten a hike in January. So what would be different this time around? But on a more serious note, if you look at the voting patterns for the November meeting, the MPC members unanimously voted for a hold. If you listen to the Q&A session, it appears that they are relatively comfortable that the current level of interest rate is sufficient to drive down inflation to their desired level. And since then, since the last meeting, we've had a Fed meeting and from the first statement, it has turned a bit more dovish, and this is in line with what we expected. Oil prices, notwithstanding the volatility, have come down a bit, and the rand is relatively stronger since the last meeting. So, if we look at the inflation trend, it is supportive. There is scope for a cut in the near future. Inflation itself did come down in November to 5.5%, and it actually declined on a month-on-month basis. So we think that they are quite comfortable with how things are progressing, and they probably would like to see a bit more, more data points to make sure that inflation is on the right path and it is going to be anchored around their desired level before they make the next move. Now, there are still risks embedded in the system at the moment, and this includes geopolitical tensions, the state of our fiscus and its impact on funding costs. You mentioned elections, not just in South Africa, but around the globe, and all the volatility that comes with. So to answer your question directly, Suren, it is still a bit early for a cut, but we are expecting a cut sometime this year.
Sometime this year, can I push you a little bit? Not in January, not in March, maybe in the second half of the year, or could we see something in the second quarter?
Interesting question. Look, when I look at consensus, most of our colleagues believe that we potentially are going to see a cut in the second quarter of this year. Our view is that we're potentially going to see it at the beginning of the second half next year. So there is a bit of uncertainty around the exact timing. I did allude to some risks embedded in the system that leads us to believe that a cut is potentially in the second half, at the beginning of the second half of this year.
It is a tough residential property market. Currently, we're seeing some defaults and that sort of thing with interest rates at now over a 10-year high. How did the residential property market perform last year?
So there are a few things to note here. So the first one is that following the above normal transaction activity between the second half of 2020 and 2022, demand for property is expected to have reached its trough in 2023, especially in the fourth quarter of 2023. Available data suggests that volumes have declined by around about 25% to date, and this is data up to the third quarter of 2023.
Wow, 25%.
Absolutely, and I'm specifically speaking about here mortgage transaction. And what we see is that decline is actually more pronounced in higher priced segments. And by contrast, activity in the lower priced segments benefited from what we call the buying down effect, the buy down effect, as buyers look for more affordable solutions. So this isn't necessarily to say that the low income consumer was relatively insulated. It just means that those in the middle and in the high income echelons were looking for cheaper properties, which supported volumes in the lower end of the market. Furthermore, we saw that the subdued economic activity and the high interest rate environment impacted younger individuals disproportionately, and this includes first-time buyers, while stronger balance sheets softened the blow on older buyers. So if you look at the numbers, your younger than 35s have gone from being the more dominant force in the market in the 2000s. So they were about 54% of total mortgage volumes in the year 2000, compared to just about 40% year to date. And there are many factors around this, and I'm not going to get into too much detail around that. But one of them is the high unemployment amongst the youth. But be that as it may, it does have implications. We often speak about property as the biggest investment that an individual will make. So the despondency among the younger buyers in South Africa has implications for wealth distribution in the country. So now when we look at it from a price perspective, so we were talking really about activity. So now when we look at the price, look at it from a price perspective, similar to the trend we are seeing on volumes, price growth did really slow in 2023, but it's starting to level out now, especially in the later months of the year, November, December. And although there are noticeable variations across location and property values. Now, lower priced segments continue to outperform, in part reflecting the buying down effect I just alluded to, while this immigration trend where affluent individuals sell property in the inland and buy in coastal towns has supported demand in property values in higher price segments, specifically along the Western Cape coast. So we saw those divergent trends in the market. And finally, we saw also in 2023 the most intense load shedding, especially in the first half of the year. And this definitely disrupted activity, especially if you think about the high crime rates in the country and limited lighting. It sort of dampened the mood of prospective buyers, and it affected volumes, especially in the first quarter of 2023. We also saw homeowners investing in alternative sources of energy, a trend which actually commenced in 2022 and it spilled over into 2023. And it also got marginal support from the solar panel incentive that was announced in the February budget, although, as I mentioned, the trend actually predates this incentive. So that intervention, one could say, that was way behind the trend. And we did a study on this, Suren, just to understand the dynamics, just to understand the impact that load shedding and the installation of solar panels has had on the market. And what we find is very interesting. What we find is that the unprecedented levels of load shedding over the last 12 months or so have induced some shifts in buyer preferences. The results suggested that there is a greater demand and a willingness to pay a higher price for a property that is pre-installed with a solar solution. No surprise there. However, we find that this is actually more limited to the affordable market. market. And on this score, most agents, estate agents, estimate that the solar panel premium is generally within around about 5% range of the purchase price, but could go over 15% in certain instances. And I mentioned it's more on the lower end of the market. In the higher end, in the higher priced segments, however, pre-installed energy solutions play less of a significant role in the buying decisions. And this is because your wealthier buyers much more prefer customization, much control on what kind of a solution they install in their properties, the quality, and all of those things. And they know that they have a more superior access to funding models, to funding solutions, and they are able to customize, these solutions to their desire. So in addition to the buy-down effects, as well as the long-standing supply shortages in the lower end of the market, this explains why property values performed relatively better in the affordable market vis-a-vis in your more higher end, in your more luxury market.
Thanks for all those insights, Siphamandla. Turning to the outlook for 2024, what are your expectations? As we mentioned, it's an election year. About a month or two ago, I chatted to Tyson Properties founder, and he said generally election year sometimes affects the property market. What are your thoughts?
So the best way to visualize this is to think of a swoosh symbol. So we think that we are now at the early stages of that lazy turning point, that lazy cusp of the swoosh symbol. We think that for the next 6 months or so, we are probably going to muddle through. You mentioned the elections, and it's one of the factors affecting the market, and that is an absolutely correct assessment of the market. We tend to see, typically, we in an election year, with all the noise that it comes with, prospective buyers tend to, employ a wait and see approach, and we think that that is what is going to play out this year. So especially in the first half of the year. So we're going to muddle through, although we do think that we are now at the bottom of the cycle in terms of actual activity. We think that once that noise has died down after the election, we may then see those delayed buying decisions filtering through into the market, and that is going to gradually lift transaction activity starting from the second half of the year and all the way into 2025. In the end, we expect that annual volumes in 2024 will remain relatively unchanged from 2023. Once again, think of that swoosh, symbol. We end up at the very same point that we started at around about the end of 2023. And this is very important as well. This level that we predict for 2023 is approximately 10% below pre-pandemic levels. And by pre-pandemic levels, I mean the 5-year average between 2015 and 2019. So this is, low activity, kind of a market that we expect in 2024, with the second half of 2024 performing better than the first half.
Could it turn out to be a year of two halves then, not just the elections, but if interest rates start to come down in the second half or latter part of the year, there could be more activity in that second half as opposed to the first half?
Absolutely. It is. You summarized it quite well there, Suren. It is going to be a game of two halves. So currently, we pencil in, as I mentioned, the first cut in interest rates to be in the second half of 2024. But as I mentioned, consensus is somewhere in the second quarter of this year, so a couple of months early. I think it's fair to say that there is a bit of uncertainty around the exact timing, as I mentioned, and all because of all those event risks I alluded to earlier. So be that as it may, we think that the next move in interest rates should help home buying activity pick up steadily especially over the forecast horizon. And our forecast horizon spans from 2024 to 2026. And as mentioned, we are probably going to settle below pre-pandemic levels in the near future, but it gets better once we get to 2025 and 2026. The gradual decline in inflation and borrowing costs, combined with some employment gains, surprise, surprise, should modestly stimulate demand in the interest rate sensitive segments. I mentioned your first-time buyers. I mentioned your younger than 34 buyers who have been despondent in the market at the moment. So we expect those gains to come through more in the medium term than in the near term. And this could see volumes mean reverting by 2025. So it's a combination of factors. It's not just interest rates, although interest rates go a long way in stimulating that kind of a demand, especially from first-time buyers, especially from your more younger buyers.
Thanks for that. Just to conclude, we're running out of time. Besides expectations for interest rates to come down, there is pension fund reforms that the government has instituted that's going to come into effect this year. That could put more money in the pockets of consumers. Do you think that will also be a positive effect for the market, or would they rather spend that money on cars and holidays?
I think more the latter. Look, while this is going to put more money in the pockets of consumers, we don't think it's big enough to have a meaningful impact on the property market. It might assist, your interest rate sensitive buyers in putting up, that down payment, the deposit. It might also assist your existing home buyers to pay down their debt. But in terms of stimulating new demand, we don't think that is large enough to have a material impact on the market. But as you say, it does put a bit more sense in the pockets of consumers, but not large enough to tilt the scales of demand in the property market.
Siphamandla, we will have to leave it there. That was Siphamandla Mkhwanazi, a property economist at FNB.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.